the group has continued to grow. It is a 1.7 billion, 1.7 trillion shillings balance sheet. Those who know, that is about 10% of the entire economy of Kenya. So it's a huge, and that's what I was saying, when you talk about 1.5, the insurance business has become, it's 1.5 of a very significant balance sheet. But as we can see, this year, if you look at this balance sheet, what would you see? An organization that has been very busy restructuring its balance sheet. And if you look at the restructuring, it's led by the liability side. During difficult times, we saw the customers have reduced the loans by 5%. Equity is also behaving like a prudent customer. And as you can see, its borrowing from global development banks have shrunk by 68%. Why? Because our borrowing rates globally have moved from 3.5 to 12%, and said, then this is not the period to borrow. And I guess that's what the customers have said. Our interest rates have moved from 13 to 18%, because that's where the central bank rate is. That's where treasury bills and bonds have been, and so declined. So we are very excited that we have very strong liquidity that we can choose to restructure our balance sheet. So a reduction from 214 billion to 70, so it means we have paid 150 billion. So if we looked at that at the balance sheet level, the balance sheet could have been 1.9 trillion, but we chose to retire the expensive debt because we don't want to pass it to customers. Breaded finance, commercial loans and development loans, it was not working anymore because of the cost of debt. But look at customer deposits. Despite the customers reducing their borrowing by 5%, they have increased their deposit by 9%. I believe it is not that the total banking industry deposits have increased. The banking industry deposits have shrunk, but equity has always been perceived as the safe, secure place during difficult times. And that explains the growth in deposit. It's where people feel confident, comfortable that their money is safe. It's the tree that all of us can take shade from, because generations for 40 years have sat under this tree and they have had the shade. And if you want to look at our history, we are now 120 years old since the establishment of our subsidiary in DRC in 1909. So yes, we brag of being the oldest financial services provider in the region through the acquisition that we made in DRC. So that balance sheet is heavily structured, and we see again the restructuring not only by our borrowing, but also the customers borrowing, our loans going down by 5%, but because customer deposits have increased, then cash and cash equivalent has significantly increased by 12%. And as you can see, the increase is not put in government securities, because we want near cash. We want, as the tide turns, we want to reallocate resources from near cash to customer loans. We want to support. But we're also very excited that during difficult times, when shareholders have come and said, yeah, we want to support you, we want to really ground you well, and shareholders' funds have gone up by 17%. This structuring of balance sheet we will see has affected the P&L significantly. And you'll see why we had to do this restructuring. So as we get into the P&L, we see the biggest challenge of the group has been at the top line, where interest income is growing much slower than the interest expense. Interest expense growing at 18% on interest income. And that explains why, to try and deal with that challenge of top line, that we thought the biggest source of growth of interest was on foreign denominated loans, which increased from 3.5 to 12. That's 3 times. A growth of almost 4 times, and that was what was driving that. And so we'll quickly see this being improved in the fourth quarter, and by beginning of next year, that problem will be solved. But it also speaks to equity, and we take pride that the central bank has published, and as the tier 1 banks, we have the most affordable interest rates. We chose to start with our customers, instead of passing this interest to you, we better redeem it. Let's not increase the tide is the tide is breaking, and we have the future going forward with. So net interest income goes up by 11%, and as we said, non-funded income, because of reduced activity, down to 4%. Total income only at 8%. But look at loan loss provisions, 43%. Why? Because that's what who equity is. Although the NPLs have peaked, we can tell with the certainty, we felt that it's good to be prudent, it's good to be defensive during difficult times, and that explains why total costs have gone up by 6%. Profit after tax up 11%, and profit after tax, because of efficiency in tax management, goes up 13%. Earnings per share up 13%. So that broadly brings us up to a profit after tax of nearly 41 billion shillings. And we're happy that during difficult times, we could start with the shareholders. This is a profit out of efficiency. As we have seen, it is not about interest income, it's about efficiency. It's not about dressing accounts. You can see how conservative we are with the provisions, optimize the provisions, make sure the coverage is very strong so that you free yourself into the future without challenges. So that gives us a feel of the balance sheet, and then of balance sheet and P&L, and then of course the headline numbers that everybody would like to have is customer deposit up 9% to 1.3 trillion, loans down to 5% to 800 million. Balance sheet, 1.7 trillion. Total income, as we said, 139 billion. Profit before tax, that's a number that people like quoting, 51 billion. But profit after tax, 41 billion. Very efficient tax and efficiency ratios, as we have seen, the NIMs, the cost-income ratio, return on asset, and return on asset, decent returns. But the real test of a bank is in its ratios, and when you look at the capital ratios, very, very strong asset quality ratios, given the coverage, the cost of risk because of the provisions that we talked about, the leverage, looking at the leverage, the capital ratios, 15.9 or 16% core capital to risk weighted, and 18% total capital to risk weighted assets, and a liquidity of 55%. We couldn't be with a better agile balance sheet. So we ended up, the restructuring moved the balance sheet to a very agile balance sheet, because we needed that agility as the storm breaks, as the headwinds break, so that we can really support the market. We are very excited with what the Central Bank of Kenya is doing, focusing on lowering its appetite by reducing interest rates. It had crowded when it was offering 18-17% for treasury bonds. It had completely crowded out the private sector, the financial sector. But with the lowering of interest rates, then we'll see reassignment of funding to the private sector. And we hope that will accelerate. Equity, hopefully within the next 7 days, will be announcing its second cut on interest rates, again to pass these benefits to the customers and encourage offtake of loans, and hopefully ease the pain that customers and households are going through. So you can hold us to an announcement within 7 days of a second reduction of interest rates. It's in our interest to work with the government to stimulate the economy, so that economic activities can be created of the market. Then we fund the young people to take advantage. Our foundation is busy training on entrepreneurship. So it's all systems go so that we can ease the pain households have gone through during a very difficult time. And we hope that the political events that we are seeing throughout the world will not bring another shock. We are praying that we have had 7 shocks since 2016, starting with the interest capping of 2016, COVID, the last year Ukraine war, the Middle East challenge of Israel, COVID, and of course, the biggest one of them, the global macroeconomic turbulence of very high inflation, high interest rates, and volatile currencies. Our prediction is that we'll end the year still strong, with deposit growth holding at 9 and decline in loans holding at around 5. If the central banks move fast and hopefully will give us another cut before the end of the year, then we'll see maybe credit uptick, and we'll see this reversed by the first quarter. Everything else seems to be holding. The prediction, the strategy team and the prediction team seems to have done a fairly good job in predicting the future. And the market continues to reward us very well, despite having second largest balance sheet in market cap, market valuation. We stand tall in the market with a market cap of 165 billion shillings.